Hey traders, Nick Shaheen here looking at Roku one more time. I did a video before the earnings and then somehow I got into a battle war on Twitter and some guy called me lame and clueless about it because I suggested that it's late in showing the ability to profit, and he took offense to it, got totally butthurt about it, and called me clueless, even though he's been following me for years on Twitter. So go figure. If I'm clueless, why are you following me? I'm definitely not funny, so not sure what you benefit from following me. Anyway, that aside, I don't mind the debate. All I presented was the other side of the argument, and I really don't care. I trade it more on the long side than the short side. I was short into the earnings, so I benefited from that a little bit. But it's not a conviction short where I'm saying like I'm going to short it until it dies. I'm just saying that I understand the concept. He was trying to teach me a lesson about the concept of growth and how you need to spend to grow. Hey, I'm the one that said that like for years over stocks like Amazon, for example. I don't want profitability. It's a growth company, so I measure the price to sales. So from that perspective, Amazon's PE is whatever, 140, and people keep referring to it. Oh, it missed on earnings. Who fucking cares? It doesn't matter. It grew 42% on the top line, and even then people nitpick, oh my god, the growth rate fell to 29 point whatever percent in AWS. That's a disaster. Again, who fucking cares? They grew 40% the top line. So that's the point. The company grows and it shows the ability to profit whenever it needs to. Well, this company has been in business 18 years-ish, and I still don't see it, and I've given it the benefit of the doubt. I said, okay, let's erase the first 10 years. Because streaming wasn't there. Now streaming is there. During the COVID, everybody else is exploding. Where is the explosion here? I didn't say short the company. I'm just asking questions. If I'm long the stock, wouldn't you be tired? So I asked, how many more years do you need to see of this before you say, okay, time to show us some? Anyway, having said that, the chart is great to trade. It respects the technicals really well. And it's really easy to forecast right now. So last week, it wasn't an obvious point of entry after the dip, even though it bounced right away. It bounced where exactly it should bounce, but that's how Head and Shoulders print. They bounce, and then they try to rally, and they fail lower than the prior bounce, and then they bounce again until this neckline breaks. So what neckline am I talking about? So I have my orange line somewhere around here. It says buy the dip. See? I'm profitable. I'm not bearish. If I did, I would say short it. Watch for a short. I didn't. I said buy the dip. You can see it right there. So this is a note to myself. So if it bounces here, it's buy the dip with a tight stop, because there's another lower level that is also a buy the dip around 143. But if it fails, it's like a head and shoulder with multiple shoulders. You see what I mean? Tight, they rally, they fail, and then they lose the neckline, and then they fall to the next neckline, which is buy the dip too. Again, I'm being on the positive side. This probably says, well, usually I would say chase the breakout or fade it. So if I'm long, this is where I book. If I bought this, they should have booked here, because they're coming into a prior fail. They should have booked or trimmed or locked or whatever. So if I bought calls, I'd sell calls against them to lock in some profits. And here we are. So you can rinse and repeat this support until it fails. Forget the news, forget the fundamentals. This is a trading perspective. So if you love the company for the long term, you don't need to listen to this, because you don't care. You're in it for the long run, and you have conviction in your thesis. I'm not here to tell you you're wrong about it. Only time can tell you that. So sit in it forever until you see the point of where you either change your mind and you say, see, I told you. So this is a trading perspective on the chart. A drop into this level, first of all, need to hold or lower comes. And a drop to this is a buy the dip opportunity. So in theory, prior breakout levels should provide some support on the way down. And until further notice, whatever support has been going on, the assumption is that it should hold until it doesn't. So it's the trigger if it fails. So how do I trade this? If I'm not long or short, I can try to swing long from here, assuming the support will hold with a tight stop. The tight stop meaning if my thesis, which is support holding, fails, I should get out as a trading one. Or I would wait the breach, and if I wanted to short it, I can, or I would wait to see the breach and wait for this and buy it down here. So all these are viable. All depends on time frame. It all depends on style of trading, how to do this. And I'm assuming I'm talking about options here. So these are my marks on the chart, and it says resistance zone, also the opportunity, and it broke out halfway through to my potential rally level. Let me see if I can zoom out and show you how it is. Okay, so this is it. This is a daily chart, which is what most people tend to look at. So I said this was the opportunity, and as soon as it broke out, I sent the alert to the readers, and I said it could go in 2 jags, and it failed after the first jag because of earnings. So the headline ruined it. But the trade was to chase it from here, to start booking on the first jag, assuming that there's going to be a fade into the second one. So when profits come pretty quickly, I like to book some. All right, so now you can see where the support should hold. And if it doesn't, then it should come back down to the next level of the next pivot level, which is pretty clear. There's nothing clearer than like 136-ish. You have a set of candles here. It's a clear neckline. There's no reason why they lose that without a fight. From a price action, again, I can see why it should hold around 145. So all depends on conviction. I can see why I should chase the breakout. So ignoring the fundamentals, which I started this thing by addressing, this thing is technically exciting to trade because it's clear with its levels, at least now it is. Fundamentally speaking, they still lose money. They're 16 times price to sales, which is not outrageous. Believe me, I've seen some outrageous things out there, but this is about 3 times more expensive than Amazon. From that perspective, just the stock price to whatever full year sales it has. You know, you'd think you'd want that to be, the lower means the less hopium. But let me see if I put it in English, plain simple English. I walk up to a business and I say, you know what? I love your company. I'd like to buy your pizza shop. I'm going to pay you 16 years worth of full year sales right now to take over your business. That's basically what I'm doing if I'm buying the shares right now. Sounds high, and it's only 5 or 5.5 for Amazon. Sounds low. If you want to see outrageous, go out to the Shopify. I think the worst that I've seen lately is Zoom. 110 fucking years worth of sales in today's stock price. What kind of expectations do I have from growth on the top side? Anyway, these are my thoughts for Roku. And again, if you get upset from me saying that anything negative about it without insulting it, I'm not saying they're goddamn idiots. I'm just saying that maybe they should start showing some the road to profitability as to like, okay, we're going to be doing this advertising, we're going to be subscription based, we're going to upgrade this, we're going to merge with that. But it's not clear enough from what I know about it. And I'm not an expert about it. You might know more. That's why your thesis is different than this discussion here. Nick signing out. Oh, there is a link. First of all, subscribe to this channel. It's free. And or join us in the chat room. We do this all day, every day. It's totally fun.